We start off with the commodity crush. Oil taking a deep dive into the close, settling down 4% today. Crude is now down 12% in the past month. And copper, typically a leading economic indicator, is also down 9%. Check out shares of U.S. Steel. That stock is down a whopping 22%, hitting fresh lows. So is the commodity market sending a warning sign to the rest of the world? Are we living in a new slow growth reality? Guy.
Yes, but before I answer the question, welcome back. You've been missed.
Isn't
it great to have Melms back?
Great to be back.
What was the question? No, I know what the question was. The slowing commodities move lower. Is it a slowing growth? Absolutely it is. If you say otherwise, I think you're just not paying attention. You go to U.S. Steel, for example. You want to talk about steel stocks. U.S. Steel in March of last year was a $45 stock, headed to $50 easily before President Trump started all this tariff talk, rightly or wrongly. That stock, and Tim Seymour said it the other day, is trading like it's going out of business now, sub 13 on an S&P 500 that's basically around all-time highs. That's telling you something. Freeport-McMoran below $10. That's telling you something. The move in crude oil, despite all the noise around it, is a significant move. That's telling you something. Now, central banks will think by lowering rates that somehow magically will help. That will hurt, in my opinion. So they're doing it wrong. When 24% of global sovereign bonds have negative yields, that's problematic.
Right. And of course, in the commodity crush, we haven't mentioned bond yields, which are basically confirming what commodities market is telling us.
I agree with everything you said, except if the Fed cut, I think that market would actually go up. A lot of costs for people would go down. But commodities are just that. They're commodities. So when the supply demand gets out of whack, you see really big moves. This is as bearish as I've been in a while. I'm really concerned about the economy. I really am concerned that a trade deal is not happening anywhere in the near term. And so CEOs and consumers pull back because of uncertainty. The market hates uncertainty more than anything else, more than bad news even, right? If you think about stocks that have lumpy earnings, even though the earnings stream may be equal to that of a company that has, very steady earnings, the company with steady earnings will trade better just because people like certainty. So I'm really not liking this market. I'm always long, and I will stay long. I try to think about how can I hedge. The VIX ticking up here. The one thing I did today was sold some HYG short. We haven't seen the credit markets get nervous.
Right.
And I think that's coming.
And that could happen with oil. I mean, remember, a lot of what's in HYG is related to oil. Oil looked horrible today. I do think that is a leading indicator for the economy. What I think is happening here is the markets globally, commodities, equities, bonds, are all pricing in something Guy's been talking about for a long time, which is this trade war is not going to end anytime soon. It could even take until after the election. That's what Trump said several weeks ago, which actually got me concerned, that he said China might be waiting until after the election to see if Trump gets voted out. That is what I think the market is pricing in at this point in time, and that's a problem.
I mean, the bigger question is, even if the trade war goes away, does economic slowdown abate? I mean, or are we still facing a slowing global economy?
It's my view that's what the 10-year Treasury yield on its way back to 2% really reflects, if you look at the move that we've had over the last few months. And I think that if you're taking solace as an equity bull in the fact that the S&P closed up today, after this 5% decline from those recent all-time highs that they made, then you're looking at the wrong thing. Because, last night, Jeffrey Gundlach, we all concede, is probably the smartest bond guy on the planet, tweeted out last night that might have been a blow-off top in long-term U.S. Treasuries. Well, what did we have? We had a little bit of a rally in yields this morning, back above 2.25 in the 10-year. What did they do? They closed on the low. What happened after that? Oil started to accelerate lower. Banks started trading very poorly. Your copper trades like,
horrible
garbage. And so, when you look at all those things together and you say to yourself, okay, lower yields, that should mean a lower dollar. But the U.S. dollar index doesn't budge. So you're seeing two safe havens, right, emerge here. You're seeing U.S. Treasuries and you're seeing the dollar. And that combination, back to your point about if we got a rate cut that we might see equities rally, I don't think so, because I'm not certain the dollar comes in. And that combination could be really, really nasty.
I don't think the dollar comes in. I can tell you from the people I'm talking to, there is a scramble for short-term dollars right now. It is difficult to borrow dollars in the short-term market. People just want dollars. So the dollar is not going lower. And just remember, even in the last QE, the dollar actually went up. So even if we had just massive QE again, you could still see the dollar go higher.
Karen just said she's the most bearish she's been in a while.
Well,
You sound sound
I mean,
the
I've been
same way.
relatively bullish all
Right.
year, and once Trump said it might last until, or the Chinese are waiting until after the election, I think that changed the game.
So what does your portfolio look like now? I mean, are you short anything, or are you?
A lot of Bitcoin.
You're long a lot of Bitcoin.
No, I mean, I actually did. I'm not short anything. I did sell a lot of my equities. I sold out of my oil. I actually even sold out of some gold at this point in time. There'll probably be a point to short something very soon here.
Still think healthcare is a place to be. I understand that some of these names have gotten sold off, but if you look at names like Eli Lilly, Pfizer to a certain extent, some of these biotech names, I think that's where you want to be. We've talked about UNH for a while. Obviously, that sold off a little bit over the last week and a half with the broader market. But if you just look at it in reality terms and in terms of valuation now compared to what's historically, I think UNH is a buy. But I'll say this, technicals, if you want to bring them in, we've mentioned this a dozen times at least. The fact that the S&P traded back up to the all-time highs, 29.45, give or take, and failed, technicians will now say the lower we go that we have a huge double top in the S&P 500. And the fact that the Russell didn't come close to testing its all-time high from the fall is really problematic. So to your point, the VIX being down today with still a 17 handle, in my world, that's way too cheap.
Yeah, but can I mention one point? You mentioned U.S. Steel before, and, I was taking a look at it. It's trading at multi-year lows here. It's still above where it bottomed out back in 2016. But you see equity implied volatility is just starting to tick up. It's still well below where it was in 2016 when it looked like it really was going out of business. And when you think about the price action here, I think you can take a look at the CDS. That's the credit default swaps on the debt. That's insurance against the debt. It's actually blowing out right now. Now, it's not blowing out to levels where it was in 2016, but these are the sorts of things you kind of want to start thinking about. And that goes to your point about HYG. We don't talk about HYG until things start getting hairier, and then we have like an HYG bug up on, on this thing. But I think it's really important to take a look at it. And I just want to make one other point. You mentioned about the tariffs, and they started on aluminum and steel back in March of 2018, and letter X was trading, where was it?
44.5.
It's down 75% since then. And then I see a post on the Wall Street Journal's Daily Shot this morning saying that actually these tariffs have not been good for steel jobs in America. So you put those two things together and you say to yourself, oh my goodness, steel is not doing well here. These companies are actually not doing well. The people that use steel for inputs are not doing well. We're not adding jobs. We're going to get into an election season and things could get really, really hairy here, because if no one's winning this trade war, then we got a problem. And I'll just go back to, if you're looking at it through the lens of the stock market, you're looking at the winner of this trade war altogether wrong.
Most investors at home are in your position, Karen, where
Right.
they're always long. They will always be long in their portfolios. But
Right.
what do you do in this market environment?
Well, I do. Well, normally what I like to do, I say when things trade down in integers, that I like to buy when there's blood on the street, even if it's your own. I'm actually not really buying anything right now because I think it could get materially worse. I think it wouldn't shock me at all to see some positive trade rhetoric in a tweet somewhere. That wouldn't surprise me. But I think each time we're going to have less and less bang for that tweet because companies are really are in not disarray. That's the wrong word, but they're confused, and that makes them sort of tentative. And tentative isn't a good thing for the economy. So I don't really do a lot. I don't panic and sell things, but I'm going to wait and sit on cash. I think we will see a bigger downdraft to employ that cash.
Quick point, I think this is really interesting to note. This week we had two really high growth, high valuation names in the tech space. We had Workday, and we talked about it the other night. They reported, and the stock sold off about 5%. I think it was kind of bounced a little bit over the last day or so. But this is a company on a GAAP basis that loses a lot of money, like a lot of these new issues that have come to market and have done very, very poorly, if you think about some of them. And I think it's interesting to see that if that were to top out, we saw Palo Alto Networks. This was also a darling. It's down an awful lot in a very short period of time. When you start losing some of these darlings that people were just kind of dismissing valuation and dismissing gap losses, that sort of thing, that's one of the things you really don't want to see when you see the S&P 500, which looks like it made a massive double top or head and shoulders or whatever you want. So you don't want to lose those high sentiment kind of names, and I think we might be starting to lose those right now.